We begin with the economy. Annual revisions from the Bureau of Labor Statistics show the U.S. jobs market was weaker than originally reported. The Bureau says employers actually added 911,000 fewer jobs between April 2024 and March 2025. So how many jobs did Nevada actually add? And what does this new data mean for the Federal Reserve, which could announce interest rate cuts on September 17th? For that, we bring in John Restrepo, principal of Las Vegas-based RCG Economics, and Andrew Woods, director of UNLV's Center for Business and Economic Research. Gentlemen, welcome back to Nevada.
Thank you, Amber.
Thank you, Amber.
So the report that I just brought up, 911,000 fewer jobs added in the U.S., and in Nevada, 3,100 fewer jobs added. Does that mean much to you? What do you think of that, Andrew?
Well, it means a lot in terms of what we're looking at for trend and rebasing our numbers. You know, these revisions are common. They always have been happening for decades. The statistical methods that the BLS uses, have to be checked with. What they do is they actually check it with unemployment data coming out of the states. So the revisions weren't surprising. I think what's been more concerning over the summer is that we've seen that hiring has slowed. And then number of job openings has started to slow down too, as well nationally in the economy. You have seen a slight uptick in the unemployment rate. Of course, it hasn't gone up as much as maybe some have forecasted, which maybe also still points to that firms are holding on to their workers, but they're not letting go of their workers. So we're kind of at this weird point in the economic and business cycle where the economy's trucking along, but they're not hiring workers as much as they were in years past, which means a slowing economy, but it's still positive. So what do you do with that information, and where do we go from here? Which I know that's why John and I are on here to talk about.
Yeah, John, where do we go with this information? What do you make of that info? Or
let me add to what Andrew said. Remember, this correction that we just saw, this 900,000 per person, we haven't seen anything this major since the early 1990s.
So it is a big deal.
So it is a big deal in terms of the level of correction. The fact that they're correcting things with the quarterly data, correcting the monthly data with the quarterly data is not unusual, but the size of the correction. So what's causing that? It's probably because the economy's evolved and changed over time, and maybe the methodologies at some of these federal agencies, the Bureau of Labor Statistics or the Bureau of Economic Analysis, need to be updated to 2025. It could be the way they survey, how they survey, things like that. So some methodological advancements and innovations need to take place now, particularly with all the advancements we have in technology to do that. We also had in this most recent set of numbers the impact of all of the deportations, immigration issues that we've seen in the last 12 months. And so that comes into play as well. And so there's a lot of kind of noise right now in the data, but we're pretty sure, and you mentioned it earlier, these are not, the BLS and BEA are not political organizations. They're statisticians, they're number nerds like Andrew and I. And so they're just trying to do the right thing. Maybe their methodologies need to be improved, but these are not people that are cooking numbers or make any administration look bad or good.
And one of the issues you get there is since the COVID pandemic, across the board response to surveys for the government data has declined, and particularly that one is below, I think, at or below 40% response rate, whereas before the pandemic, it was at or above 60%.
Yeah.
And so you're just going to get these wild swings in these numbers because they have to go back and check them, but you're getting lower and lower response rates.
Right. And part of that, real quickly, just to add to that, I'm sorry not to belabor the point, is, we've cut back the budgets on these agencies that do the data. So now we have fewer people with a lot of work they have to do to maintain this information, with business depend on it and all these sorts of things.
And changes in leadership
and
as well.
And so it's kind of funny. You can't cut someone's budget and then expect them to do the same level of due diligence and data confirmations. Someone said the other day, yesterday on the news about this, an economist said, it's like cutting your neighbor's tires on his car, and when they don't move the car, blaming the neighbor. Right? And so you have to just be very careful. So a lot of it is budgetary issues and things like that too as well.
You brought up increased immigration enforcement and its impact on the jobs market. Have we seen that in Nevada? Has it had an impact so far for either of you, do you think?
We haven't seen it quite yet. I think there hasn't been a lot of this ICE enforcement happening here in Southern Nevada or in Northern Nevada in the agricultural economy. You know, we haven't seen that quite yet. Will it happen? We don't know. That's going to be a political decision, right? What cities, what metros, what states are being affected by this ICE activity. So no, we have not seen that quite yet. What we're starting to see more, though, is slowly seeping in the impact of tariffs.
One more question on immigration.
Okay.
There is increased immigration enforcement in California. How does that end up impacting Nevada, or does it at all?
Well, so at UNLV Center for Business Economic Research, we do the population forecast. We've been doing that since 1997. We look at not just the year ahead, but the next 60 years. And a large driver of our population growth, especially since the pandemic, has been immigration, which could be coming from California. But we also know California in general is 60% of our growth comes from the population moving from California. So there's this question that we have is if you have lower international migration in the United States, that's going to filter through to the Nevada economy, because a lot of those workers backfill the jobs that domestic workers that live here in Nevada don't necessarily want to do, which is a lot of these entry-level jobs, say in leisure and hospitality or construction, which are very much kind of drivers of growth in Southern Nevada.
Right.
So it's not immediate in terms of like month to month, but we're anticipating, and when we go revise our numbers in February, March, and April, we're expecting to see a big impact on limiting our ability to grow, because who's going to take these entry-level jobs?
Right. That's right. And the other thing, too, tied into that, Andrew makes an excellent point, is that, you know, an international visitation is an important part of the Nevada experience. I think 10 or 15%, I can't remember the number.
It's about 11 to 12.
12% or foreign travelers. And so when we're fighting with foreigners, when we're threatening the Canadians to make them a 51st state, all that other stuff, and we're charging Canadian or foreign visitors an extra fee to come here, and all these sorts of things, and dealing with creating kind of anxiety among our allies. They're not coming here as frequently, so that's all part of the immigration discussion as well as the foreign visitor.
And the drop in tourism that we have covered here on this show.
Right.
But tariffs, you mentioned, what impact have they had thus far?
It depends on the product, it depends on the country, but it's still flowing through the system, right? And so we're starting to see, like Andrew mentioned earlier, I think offline, there's certain consumer products that are going up. I'm noticing where price at a restaurant, for example. My wife and I were in LA visiting my daughter this weekend, and we noticed that the prices haven't changed dramatically. The portions have gotten smaller. So you have these subtle little things like this, right? But we're starting to see the prices seep in. We're probably not going to see the full impact of the tariffs probably till the end of this year or early the first quarter, where we start really seeing the effects of it. Right now, businesses are absorbing. The importers are absorbing it in China and India a little bit. You know, the prices have kept the prices down. The American company importers have been absorbing, so to benefit, you know, so they don't want to scare the consumer. But at some point, they're going to stop absorbing these things. They're going to start passing it on.
And I think you see it in these earnings reports. So Home Depot, Walmart, Amazon have all said, like, we can't hold back much longer or at all anymore.
We can't absorb this anymore. Right?
Yeah, and you know someone's paying them, because every month you get the numbers from Treasury on how much they're collecting in tariffs, which is somewhere between 200 and 300 billion a month.
Right.
So someone's paying that. It's most likely the companies that will
importers.
eventually pass it on to us, because consumers, we will pay it.
Consumers could certainly be paying much more attention to this around Christmas time.
That's when you'll see it, yeah. It's interesting, because I saw a weird statistic the other day. 90% of all our toys that we buy in this country in Christmas items and things like that, you know, decorations are all Chinese. And so what is that going to do at some point? And this is the thing that I think we underestimated as a policy. Countries have national pride. They're not going to sit back and not respond because it's the United States demanding something. They're going to fight back in the best way they can. So that we're still waiting for all of this to play out.
Okay. Will the Fed be lowering interest rates? What do you think, Andrew, and by how much?
I think there's a very strong possibility for a 25 basis point cut next week. I think the real question is, will they do it again before the end of the year? Yeah.
What do you think?
I agree totally. They're going to increase it by 25 basis points or 1/4%, and they're going to see what to help prop up the job market because it's getting weak.
Increase or decrease?
Decrease. I'm sorry, and then to prop up the job market, stop the job market from going into kind of some kind of downward spin. But they're going to watch it carefully because inflation is still there, so they have to be careful not to create too much demand, right? Because they have to tame inflation. So it's kind of a two conflicting set of metrics that they're being looked at. But yeah, they will definitely decrease it at the end of the next week for sure.
And the president has argued that had they done this earlier, that could have, it helped with allowing for more borrowing and then allowing employers to hire more people. Perhaps the jobs report wouldn't be as bad as it is if the Fed had lowered interest rates already. What do you think of that argument?
I think that's assuming that the Fed is in the driver's seat of the economy right now.
Right.
I don't think the Fed is in the driver's seat of the economy right
Right.
now. It's the policies out of Washington, D.C. are driving the economy and affecting business decisions. It certainly can help or hinder what the Fed does.
Right.
But they're no longer in the driver's seat. And so that's how I would frame it.
What presidential policies have had some positive impacts? Perhaps the maintenance of the tax cuts that were already in place from his first administration. He implemented them, and those are staying at the rate that they are.
Yeah, I mean that's worked. The other thing that's nothing, you don't want to do it broad based, but it can work in certain situations. Tariffs can work when it's strategic things like computer chips and rare earth metals and things like that you need for national defense. Things like that. In a targeted way, limited tariffs can work. I think the president did this his first term. President Biden continued them. But when you have these broad-based, tariff everything, including, coffee from Brazil, whatever it is, it makes no sense. But so tariffs in and of themselves, in a limited way, can work. The continuation of the tax cuts from the forget the name of the Jobs Act, the Tax Economy and Jobs Act, whatever the tax bill that the president passed a number of years ago in Congress. I think it continued those probably best than not. We also have to understand that they were concentrated in certain groups too. And so let's make sure consumers are also benefiting from these tax cuts, and it's just not the large corporations and the super wealthy. So that's that. But in general, I think it's a good thing.
I think too for workers here in Southern Nevada, as part of the One Big Beautiful Bill Act, the no tax on tips and the break on overtime. We estimated last year when there was all this discussion on the campaign trail, right around 18% of the workforce here in Nevada would benefit from those kind of policies because they're dependent on tips or there's the overtime as part of their job. So assuming that actually it occurs in the way that we all assumed it's going to. Now, I think John brought up when we were talking before this is that there's these time periods.
There are
this is
limitations.
Not a permanent thing, and of course we know that they're in D.C. though, just because it's temporary, it ends up kind of sometimes being permanent as well. So it'll be interesting how this evolves with when they go back and do more tax changes, another reconciliation bill, the budget process right now. But I do think that does help benefit our workers here in Southern Nevada because we have an economy largely driven with service work, or you have a lot of workers who get overtime as well.
The only footnote I would add to what Andrew and I are saying, you have to adjust spending.
Yeah.
So with these tax cuts, at the One Big Beautiful Bill and the previous tax, let's talk about the One Big Beautiful. You also have to have companion spending cuts, and that's what no one wants to deal with, and that's what's causing the deficit and what's causing the issues that we're having right now. What's the latest? Where are we on the deficit?
We're north of what, 23 trillion?
Yeah, something like this.
Yeah.
And I want to say.
So you have to have both, and no one wants to have a cut. That's the problem.
Yeah. Well, you need to
federal
raise revenue.
offices.
Yeah, you either need to raise revenue or cut spending. But I would also say, going back to the Fed conversation about interest rate cuts, it won't really matter if we don't have the credibility that we have our debt under control.
Correct.
Because a lot of interest rates that we pay, whether it's on a new home or a car, for example, a lot of those are actually more determined by the bond market, which is dependent on the confidence of our ability to pay our debt.
And that's and a lot of foreign countries and investors are buyers of our bonds.
Own America's
So that comes
debt.
And you saw that going into the jobs report last week, that there was this unwinding between short-term and long-term interest rates because the bond market is really queasy about all of this debt that we keep
Yeah.
selling.
John,
Yeah.
I think ahead of this off camera, you described it as messy.
Yeah.
And that's what it is. So we'll leave it there. Thank you both for joining. Nevada
Thank you,
Week.
Amber.
Thank you,
Appreciate
Amber.
it.